Hello, all channel members. I hope you are home safe and sound with your family and loved ones. It is crazy in the world right now, and my heart goes out to all civilians and everyone suffering right now. So please stay safe. I've been owing you guys a video for a while, so I greatly apologize to all my channel members, including the ones that I've had and including the ones that I'm getting right now. Thank you so much. It's been really, really hectic, but I really want to give you a cool video when it comes to options. It actually warms my heart that a lot of channel members have actually been doing options, using options in a weekly basis and making a salary every single week. You see, I essentially make a yearly salary or synthetic dividend when it comes to options. Most people know options as, hey, I want to buy a call option. Some people know what it means to say, hey, I want to buy a put option. What exactly is a call option? That is an agreement to buy shares. And a put option is an agreement to sell shares. Now, if you're buying a call, you're saying, I will buy shares at a different time at a certain price. If you are buying a put, you are saying, I will sell shares at a specific price at a different time. The price that you're saying that you will buy or sell is called a strike price. And when you're doing that, you pay a premium. That premium goes to somebody. If you are buying a call or if you're buying a put, the premium goes to somebody who is selling a call or selling a put. That premium is lost to you if you are buying a call or if you are buying a put. But let's rewind a little bit. The premium that you're paying goes somewhere. I just mentioned that. Where does it go? Well, it goes to the house, or it goes to the bank, or it goes to the casino. What if I told you that you have the ability to be the bank, to be the house, and collect that premium? That is exactly what I do every single week, and what so many people on this channel have been doing every single week and making a pretty good amount of money. You see, besides for buying a call and buying a put, you can actually sell a covered call or sell a cash secured put. What the F are you talking about, Adam? Okay, you have a covered call, which means you have the amount of shares to cover an options contract. What is an options contract? One contract is always going to be 100 shares of the underlying stock. So by having a covered call, for example, let's say Palantir, you are saying, I will sell one contract, one option contract, one option contract that's a covered call, and you are covering that call with what? 100 shares of the underlying stock. This is what is meant by a covered call. And the premium that somebody is spending to buy that call is going to you, the bank, for selling that covered call. I'm going to show you an example in just a moment. Just stick with me so I can explain it, and it's really in your head and mind, and you understand the basics and the intricate details of this. Vice versa, you can do something called a sell option cash secured put, which means you are cash securing the put option, which means you are saying that you will buy 100 shares of an underlying stock at a certain strike price by a certain date, and you are securing this option with cash. So in a covered call, you need to have the amount of shares. In a cash secured put, you need to have the amount of money to be able to buy 100 shares. And this is multiplied by how many contracts you're either selling or saying you're going to buy. At the end of the day, one contract, 100 shares. I'm going to show you a example in just a moment. But before I go any further, I really need your help. If you don't understand what I'm saying after this video, comment down below. If you don't give me questions, I cannot answer you. Let me show you an option example really fast. Guys, this is my Robinhood account. Let me show you how this works. I'm going to use Palantir just to make this very, very simple. And then I'm going to give you some tips and tricks of the trade. Let me just give you an example. Over here, you would go to trade options. By the way, I highly suggest Robinhood because of the user interface. And it's free to use. If you need a link, I have a link down this in my description. You get a free stock. I get a free stock, but I don't give a fizzle if you use it or not. Press trade options. So most people only know buy a call or buy a put. Instead of buy, I want you to press sell. First, we're going to do selling an option for a covered call. Once you pick this, on the right-hand side, there's a bunch of dates. You can do this weekly, bi-weekly, 3 weeks, a month. You could literally even do this by 2026. At the end of the day, different courses for different horses, and it's all about you picking what's right for you. I personally do weekly, but I will give you some tips and tricks after this. So now I have a sell call for 5 days from now, which is going to be Friday. In the middle of the screen, you're always going to see the share price. This is how much Palantir is trading for right now. On the left-hand side is going to be a strike price. This is what's going to set your contract. So for example, if you are selling a covered call of Palantir for $18, let's just say it's this line right here. You are saying that if Palantir hits $18 by the end of the day, October 13th, then you have no choice. You must sell 100 shares of Palantir for $18. You only lose your shares. Now, if the price of Palantir hits $20 or $19, you still have to sell for $18. So that's the downfall. However, you still get your money. So you will still get $18. So be very comfortable with the amount that you're willing to sell your shares for. And you can pick 17, 17.50, 18, 18.50, whatever you feel comfortable. On the right-hand side right here, there is a number. This is your premium. This is how much you will be getting per share. But remember, 11 cents per share, 100 shares in one option contract. This option is worth $11. For example, you are selling for 11 cents. You're going to press continue. When you press continue, you're going to see this amount right here. It's $10. You're going to say, but Adam, you said that we would get $11. And the answer is yes. Thing is, when you're doing options or even when you're buying stocks, there's a spread. The spread is 10 to 11 cents. It's usually going to give you the amount that it's going to sell for. So all you got to do is go back here and press 0.11. I'm sorry. And if you press 0.11, there goes the $11. Now, you can always go the highest end of the bid, but this is a moderate chance of hitting. This is a high likelihood of hitting. So if you go for a lower limit price, you're pretty much going to sell the contract or buy the contract. As opposed to doing a higher price, you'll get more money, but the chances are not 100% that the contract is actually going to go through. And you could play with this. So now you know you are selling a covered call for a strike price at a certain date for a certain premium. This premium is multiplied by 100 shares. 11 cents times 100 gives you $11. You will collect $11 for every contract, which is 100 shares. For example, if you have 1,000 shares, you would be collecting $111. This premium is yours no matter what. If the shares do not hit $18, let's say at the end of the week, the shares hit $17.50, you don't have to sell. If the shares hit $17.99, you don't have to sell. Guess what? You keep your shares and you keep the premium. If you have to sell your shares, you keep the money that you're going to sell it for, which is the strike price, and the additional premium. The premium is always yours to keep. This is pretty good and pretty lucrative as I do them every week. Now stick around for tips and tricks, but let me explain to you now what selling a put is. Instead of pressing call, let's press put. The dates, you can do all the same, right? You could do them weekly, bi-weekly, monthly, yearly, whatever. And you still have a strike price. Let's say you do a strike price of $15. You are saying that if by the end of the week, which would be October 13th, the shares of Palantir is $15, you are going to buy 100 shares at $15, which would cost you $1,500. For this, you are collecting an 8-cent premium. If you do this, you are going to collect 8 cents times 100 shares. It would come out to $8. You would just have to change this instead of 0.07, 0.08. Okay, you would collect, sorry, I got excited. 0.08. 0.08. There you go. There goes your $8. If the shares of Palantir do not hit $15, you do not have to buy the shares and you just collect your premium. If the shares of Palantir do hit $15, you get to collect your premium and you have to buy at $15. What's good about this is you're lowering your cost basis. Instead of paying $15, you're actually paying $14.92. Now, the negative is if Palantir hits $14 or $13, you still have to pay $15. The closer the price is to the strike price, so the closer your share price is to the strike price, for example, one line above, one line below, the more lucrative the premium is going to be, and it's actually extremely significant, the premium. The further you are apart, the less premium you're going to collect. Let me tell you how I play this. I'm selling covered calls for Palantir 20% out of the money weekly. For example, if Palantir is $15, I'm willing to sell for $18. If Palantir is $20, I am willing to sell for $24. If Palantir is $10, I am willing to sell for $12. I have not seen a single week yet that we hit 20% from Monday to Friday, and I collect an extremely small premium. We're talking about 1 to 2 cents. Sometimes I make 3 or 4 cents if it's really volatile, but I'm really, really safe. For other stocks that I don't care about as much and I'm willing to sell, I'm going to do the contracts a lot closer to the strike price. In general, if you are selling a covered call, then you want to sell on a green day. For example, if the stock is green, you want to sell because you're getting further away from the initial price. And if you're selling a cash secured put, you want to sell it on a red day. Sometimes when Palantir, dropped like 8%, I think 2 weeks ago, I did a crazy cash secured put where I ended up doing like a $50,000 bet, and I made a quick $1,000. I literally made $1,000 last week as well, where I did a cash secured put on Palantir. I did like 30 contracts or 3,000 shares. I was willing to buy if it hit, I think, 1550, but Palantir ended at 16 and change, so I'm all good. Guys, I do this every single week. And sometimes if you're playing this strategy and you get too greedy, you will get assigned. Assignment means you actually have to buy the shares or you have to sell the shares. If that happens, just next week, if you bought the shares, next week you could sell the shares. And if you sold the shares, next week you can buy the shares. You understand, with the money. Let me give you one more tips and trick, which I'll give you an example because I don't have any actual contracts open right now. But what you can do is, let me show you one more tips and tricks. There's something called rolling. So, for example, I'm going to take this contract for TFC. Don't pay attention. This is a lost contract. I lost money on it. It's fine. but you're going to see a little thing right here that says roll this option. The closer you're getting to the end of the contract, what you can do is you can roll the option. So originally, this option is going to expire this week, which is going to be October 13th, if I'm not mistaken. I can roll it for a different date, right? So right now I'm ending the 13th, but I'm going to end up rolling it for the 20th, which is a week later. And what I could do is I could pick any one of these prices, right? So let's say I go, I don't want to, let's say I do this one right here, right? And I'm going to press continue. What ends up happening is you're going to end up getting a credit for the existing contract that you have. And this is going to be offsetting the new contract that you're paying for. And then you have your net debit. This is a bad example because I don't have an active cash secured put or an active covered call, but there is a rule where you can roll the option. And if you're getting very, very close, you're rolling the option next week, next week, next week until you're out of the contract, which works. I will show you another example, but what I need you guys to tell me is in a different video, does this make sense? Do you understand what's happening? And if you want an Excel sheet to track this, I have a free Excel sheet. I'll give it to you. Just give me your email address down below. I'll send you a blank Excel sheet and you guys can play with it as you'd like. I do this every single week. I make money on this every single week. A lot of my guys, my channel members do this and they make money every single week. Just understand you're a big boy or girl. Invest with money that you have. And this is just a supplemental income. But understand, the greedier you are and collect more fees, the more chances there are that you're going to get assigned, which means you have to buy shares or sell your shares. If you're doing a cash secured put, as long as you're bullish and the price goes up, you're good. If you're doing a covered call and you're bullish, as long as the price doesn't hit your strike, you're good too. Selling cash secured puts and covered calls are both good if you are bullish in the short and medium term. If you're doing cash secured puts, you got to not be angry if you get assigned. And if you own those shares, you got to be good with owning the shares. If you're doing a covered call, you got to be bullish to say, hey, I sold my shares. I'm in profit. I'm not mad that I had to sell. If you don't want to get called, collect a very small premium, but collect them weekly. Thank you so much. Have a great day. I hope this helped people. I hope I'm explaining it correctly. I need your help to know if I am or not. Thank you and have a great day. And thank you everybody for being new channel members. Mwah.